Michael Darda is back. He's chief economist and macro strategist at Roth Capital Partners. Mike, it's great to see you again. And so you would not be a fan of a pause right now, even with the market doing what it is. And look at jobless claims.
Hi, Kelly. Yeah, the markets are almost fully priced for the Fed to do another 25 here in December. And so, that's basically the consensus view at this point that they're going to follow through. I mean, I think they will, absent some kind of blowout number on Friday for the November jobs report. And that's possible considering the weather distortions in October, but most likely they go another 25. And then I think from there, it's going to slow down. Regardless of what I think, I mean, the criteria that Fed Chair Powell set out when he started to lower policy rates was essentially, one, to take the policy rate out of a restrictive zone. They're not exactly sure where neutral is, but they were quite confident that they were well above it. Now they're 75 basis points lower than they were, with a modest rise in inflation expectations since they have started to lower policy rates. And then obviously, he said the good news on inflation needs to continue. The last 2 months were hot. I think that's more noise than anything else. But the economy's holding in there. I mean, the GDP tracking statistics were, close to 3% for Q4. So I do think they're going to probably start to slow things down after the December move lower.
Can I ask you a really wonky question, Mike? Because why not? You're the guy for it. Why is it that with this basically the same end GDP growth, like total dollars in the economy now, total dollar growth rate that we had in the 2010s, why are we getting so much more bang for our buck out of it?
Yeah, well, nominal growth has been, a bit stronger, at least if you look at the quarterly statistics. The last handful of quarters, we've been running just above 5. In the average for the last cycle was around 4%. So, inflation is still a bit higher than it was during the last cycle, not drastically, but a bit over 100 basis points. And so, that's why policy rates are also higher, even though they're coming down. Even after another 25 basis point cut, the Fed funds rate is still going to be 200 basis points above the peak during the last cycle. And that more than accounts for the heat that's been on nominal and inflation relative to the last cycle.
So if that's the case, I'm going to ask a different question. If we're running, if nominal growth, again, the kind of total dollar growth in the economy is 5% now, and it was 4% back then, well, then it sounds like, then why are they cutting rates at all?
Right. Well, it's a good question, and that's one that some have been arguing for, that the Fed really shouldn't be cutting rates at all because the economy is doing so well. But it's really real growth that's picked up over the last 6 quarters, and that's happened on the back of a very strong rebound and welcome rebound in productivity, which was negative for 2 years in the early innings of recovery. So that's certainly a positive story. Hopefully that it can continue. But nominal growth has been slowing on average. If you look at like 4 to 6 quarter averages, we started out at a double-digit growth rate, then high single digits. Now we're just sort of at a great moderation trend. So the previous Fed rate hikes in QT definitely did put a damper on nominal demand, didn't crash it, but have been slowing it. It's just kind of disguised by a strong real economy. Driven by some positive supply shocks. And so with that, it makes sense for the Fed to try to take the policy rate out of restrictive territory. And, I understand the argument about, how fast should they move from here? And I think that's a totally legitimate debate. But the idea that, they should have just been sitting there at 5.3 or even going potentially higher because real growth was picking up. I don't buy that. I mean, why take unnecessary risks with the business cycle when inflation is coming down? And more critically, inflation expectations are perfectly anchored in the TIPS market. They actually fell to levels that were starting to get a bit alarming going into the summer with some weak macro data. Looked like the labor market was really losing steam. Now we're right back in a range that's totally consistent with the Fed hitting its inflation target over the next, say, 5 to 10 years. And that's really what matters. If that were not the case, then I would have a different view of what the Fed should be doing here.